You can do everything right for 20 years and lose 30 to 50% of the value of your company when you sell it if you fail one of these 5 things. I'm Arthur Petropoulos, the managing partner and president here at Hillview Partners. We're a middle market investment banking firm selling companies across all industries generating $1 million to $20 million a year in pre-tax earnings or EBITDA. And so how do owners accidentally lose 30 to 50% of their enterprise value or not get that value when they sell their business, even without knowing it? Well, these are usually the 5 things, the 5 pitfalls, if you will, that need to be avoided so that your conclusion is not that. The first of these is key person reliance. Key person, key man or women risk. You will hear lots of different definitions of it, but really it means you are doing too much. You're too involved with sales, you're too involved with doing the stuff, and there's not enough confidence that when the business transitions to the next owners, that they are not going to have to rebuild some material functions, or they're not taking a huge amount of risk by you stepping out of the fray. And so again, does it feel natural to say, I have built this myself, I created the sales process, I created the execution? Yes, but you have to have the second part of that narrative as to now it is handled in this way as to sales and the process and the machine we have in place. Now it is handled in that way for the execution and how we actually get the work done, provide the service, make the product, etc. So there has to be a clear second part of that story. A lot of people just stop. I did this, I did that, I do this, I do that. And people say, well, that's great, but how can we then buy it from you? How is it their enterprise value beyond you? That's a key element to make sure you do not fail, make sure you don't slip into that pitfall in selling a business. The second, and we've made countless videos about this, you're not normalizing EBITDA correctly. Most people just say, okay, we have revenues, we have the cost of goods sold, we have gross profit, then we take the operating expenses, then we have our net income, right? And that's a multiple of that, should be our multiple. Incorrect. The net income needs to add back interest, taxes, depreciation, amortization, non-recurring items, personal items, outsized compensation to executives that needs to be right-sized. There's a tremendous amount of things that can take your EBITDA, again, 30, 40, 50% higher than what the net income shows, if not even more. And so do the simple math. If you do a 6 times multiple on $10 million, it's $60 million. But if you did a 6 times multiple on $1.5 million, now all of a sudden it's $9 million. You're talking about a 50% increase, right? And if it was a $10 million situation, that was now $15 million. I mean, maybe the initial multiple would have been closer to 10, but I mean, now you're talking 12, 15 times. So not only does it have an impact on what you're multiplying by the multiple, but as the number gets higher, the multiple even gets bigger too. And we'll point to some thumbnails here in the screen as to our EBITDA videos that we've put out, and definitely check those out. But normalizing EBITDA is key. If you don't do it, they're not going to tell you when they're buying your business. And so it's very, very important to tackle that, and that can make a world of difference for something that you've built over decades. Number 3, letting working capital get bloated. So beyond the deal terms of a deal, so you have your value, your structure, your transition, your stakeholder or employee considerations, the main things that get negotiated, particularly during formal diligence or after you sign a letter of intent prior to closing, are going to be the working capital of the business, your transition, and the purchase price allocation. The transition being your phasing out of the company, and we'll get to that in this video. The purchase price, a little bit more tax-oriented, and we've chatted on that in tax videos. But the main thing, the biggest negotiated item in most diligence processes is working capital. The buyer says, look, I need sufficient amount of working capital, think current assets minus current liabilities, accounts receivables versus accounts payable, sometimes a little bit of cash as well. I need enough of that in the business so that I don't have to come out of pocket to fund the business post-transaction. And so they will look at, and this is what we negotiate, they'll give us a schedule and say, this is the historical working capital of the business. We looked at it over these last 12, 24, 36 months, and this is kind of historically where it's been at, so we need that delivered with the company as part of the purchase price, not in addition to it. And so think about running your business. If historically you let receivables go because, they're nice guys, they always end up paying, and you pay your payables super, super fast, and because you're a good person trying to do that, it can backfire a little bit in the sense that if they look at historical financials and they say, you know what, payables have always been really low, receivables have always been really high, so we need that spread, that gap, that delta, if you will, in working capital for us. And so if you're thinking about, and this is something that can be done kind of ahead of time, is pay the payables a little slower, collect the receivables a little faster. It will compress working capital. And then when you get into the process of selling a business, you can at least say, look, we've run this business like a non-sponsored, a non-private equity owned company. It's been owned by family. It's owned by entrepreneurs, owned by a small group of investors. We haven't been as hard on the working capital as we need it to be. However, we have in these last 90 days prior to closing, we think that's a better indication of what's necessary on a going forward post-transaction basis. And that at least gives us something as bankers to work with to try to get that working capital number down, which can be meaningful. It can be a seven-figure difference in many, many deals, and multiple seven figures in larger deals. Number 4, structuring the deal intelligently. Structure is the second most important variable in a deal other than the price. So if someone's going to give you $1 billion, and I've used this example a million times, but you get $1 today and you get the rest of it if you can swim from Miami to Manhattan or across the English Channel, with weights tied to your legs, that's not really $1 billion offer. And so what you need to ensure in selling a business is that not only is the price something that's acceptable, but the structure. And we've made videos on structure in terms of what's at closing, what's over time. What's over time? Is there earnout? Is there seller note? Is there equity rollover? What are the forms of that? And are those favorable? Are those likely to be met? You have to really take a very sober look at things and say, okay, I get it. I'm getting the cash at closing. That is cash in the bank. But over time, what's the rest of it? What's the probability? If it's an earnout, but someone else controls the operating expenses and it's based on EBITDA and you don't have any say in it, that's dicey. If someone says you have to do these crazy revenue hurdles and growth rates to get the earnout, but we're not really going to give you any more money to do it after the transaction, oh yeah, and you're not going to be involved, that's difficult. So the structuring of a deal is important. And this is an element that when people sell their businesses, the number one dispute after a deal is closed, which we have had none. I want to make that a very strong note. We have never had this situation. We've never had a disputed earnout, seller's note, or rollover piece in any deal we've ever worked on. The number one disputed element of deals is the post-transaction consideration, from everything we've read, from things we hear about. And the reason is because things just aren't written down clearly. They're not done diligently. People trust each other a little bit too much. And I don't mean to be Ebenezer Scrooge here, but to some extent, you cannot trust, oh, we're all going to be friends. This is going to be great. It's like the famous last words. And you hope that that's the case, and many times it is the case. But again, prepare for the worst, hope for the best. If it's great and we never have to look at it, that's okay. But write it down, make it very clear what is the structure of the deal, and poke and prod it and say, okay, if everybody got amnesia 5 years from now and we had to relook at this, or it's all new people at the other company and they've never seen it before, mark my word, they're going to look at the words on the document. Those need to make the case. Everything else of, oh, remember that time we were at dinner and you guys said, well, we're really going to do this. Trust me, no one's going to remember it. So write it down, structure. And the last element or way of the pitfall that people can lose, and we've seen it, not with our clients, but we've certainly seen it in the world, 30 to 50% of the value of their company when selling it is going too far down the path with the wrong party. A lot of times people will say to us, you know what, Arthur, I wish I would have talked to you a few months earlier because we're so far down the path with this one company that we've been talking to. And I say, well, how long have you been talking to them? About 1.5 years. We've given them everything. They know everything about our business. All our employees know we're for sale. All of our competitors know we're for sale. All the customers know we're for sale. We're not sure if they're the right party, but we're going to do it because at this point, there's deal fatigue and there's real pain or punishment if they turn away from it, in the sense that their employees aren't going to know what's going on, everybody's tired, and the world knows about it. And so if it doesn't happen, there's going to be a negative implication that there was something wrong with it, and that's going to be negative as well. So the key is, look, you can sell a business to a one-off party, and we've done it, where we've had a big Fortune 500 company say, I want to buy this company, do you know them? Do you represent them? Can you work with them? Which we don't represent the buyers, we represent the sellers. But we've gone to the seller and said, listen, we've got a really interesting scenario. And this might be someone that we knew was thinking about selling. We said, we've got a real buyer on hand that wants to acquire something. And this is how a lot of engagements start. And we want, and they want to buy you. And let's have that conversation with them. And then we will pivot to that conversation, but it will be a 30-day dance. It's not a 2-year, odyssey. We're going to figure out, it's like the 90-day fiance, but the results are far better. But the idea is, we are going to have a very abbreviated, expedited time period where we're going to evaluate if this is the right fit. And if it is, which it is in many cases, we proceed with that. And if it's not, sometimes the seller says, okay, that's it, don't really care, let's reconvene in a couple of years, in which case they will come back and we will sell the business a few years later. But other times they'll say, look, we've already kind of done some of this exercise, let's pivot over to a broader exercise and see what's out there and see who might be interested. And you mentioned these 10 competitors of this company that are also buying the same things. Maybe that could fit. So those are other ideas as well, but it's very, very important. You need to get to yes or no fast. Whatever the conclusion is, you cannot waste a tremendous amount of time. You can't lose detail. There is a certain amount of actual communication that must take place. However, you can't waste time. Everybody, if they think they're the only person at the dance, they will drag you around forever. And so deadlines and contingencies, of all the sophistication and technology in the world, those two things, my friend, will make things happen faster than if you just let the pieces fall into place. Because you may have your best interest in mind, and maybe other people think they do as well, but self-interest still makes the world go around. So you have to put deadlines and contingencies. That's always the uplifting things, just like the quotes every week. But the idea is, let's see reality the way that it is. And so to recap this video, 5 things that people lose 30 to 50% of the value of their business when selling by doing, and sometimes they don't even realize they're doing it. 1, there's too much centralized key person risk. You're doing too much. 2, EBITDA is not being adjusted in an intelligent manner, if at all. 3, working capital has been bloated and not managed properly such that it looks like there's more necessary working capital than there really needs to be. 4, the structure of the deal is a trust me, a handshake, and then everybody forgets or changes jobs, and it's never written down intelligently. 5, it's going down the path too far with the wrong party. Don't wait to run away at the altar. You should know a long time ahead of time if this is going to work or not, and if this is the right kind of marriage for your business. And so that's a thought for this week. Avoid these pitfalls. It really makes a difference. You can spend decades building a company, and we've seen the good, the bad, and the ugly again, we avoid the latter two in our clients, but we've seen it in this world. And we're in this swimming pool every day, and so we see tons of different outcomes. And these are the 5 primary things that people can lose, again, half of the value of a business that they've built over 30 years by these 5 things that really, if there's enough focus and if there's enough kind of persistence in getting them right, even if it's a few months before starting the exercise or during the beginning of the exercise, it makes a big difference. So that's the thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see everyone next time.